Hi everyone, so welcome back. So now we will look into a new IAS, which is IAS 20 that governs government grant. So we will start with understanding what is government grant. So government grant is some kind like a financial assistance that the government provide for the business in order to encourage the business to do something that is aligned with the government mission and vision. Okay, so the best example, for example, like the government gave government grant for SMEs that is spending for digitalizing their business. So the government is actually encouraging for SMEs to digitalize their business. So how do the government encourage them? Is by giving some kind like a financial assistance. So when we talk about government grant, there are actually three different types of government grant. It could be in terms of capital, could be called as revenue grant, and the third one is non-monetary grant. So capital grant is the name is capital, so it is related to the purchase of non-current asset. Okay, for example, like to produce something. Okay, to produce something, they need to buy a special machine, and the government can provide them some kind like a financial assistance by offering them government grant to buy that machines. But the purchase of the machines must be aligned with the government mission or vision. All right, so the second type of government grant is the revenue grant. So the revenue grant is given by the businesses, by the government to the businesses, especially when, let's say, the country is facing high unemployment rate. So the government is trying to reduce the unemployment rate. So they are offering government grant to businesses who are willing to hire these unemployed graduates. So they give them some kind like a financial assistance, maybe in terms of recruitment, in order to encourage the businesses to employ the unemployed graduates. So the third types of grant is in terms of non-monetary grant, so meaning that it doesn't involve money. So for example, the government can give a land to the business for development purpose. So this one is categorized under non-monetary grant. So in simple words, when we talk about government grant, it is some kind like a government assistance. So government provides some kind like an assistance to the businesses. So it can be awarded by the federal government, by the state government, or by the local government for a project that they consider as beneficial to the community as well as to the nation. So grant, the company can recognize grant as long as it fulfill two criteria. So the first one is condition for receipt of grant have been complied with. So let's say the SMEs, if they want to apply for the government grant, okay, to digitalize their business, there are certain conditions that they have to fulfill, and they have to make sure that they can fulfill all the conditions that has been prescribed by the government. And secondly, they are confident, or in other words, they have assurance, reasonable assurance that they will receive the grant. So if these two conditions has been fulfilled, they can recognize the grant as part of their income. So as we have looked into our first slide just now, there are three different types of grant. So each of these grants have their own accounting treatment. So let's look at the first one. For example, how do we account for a revenue grant? So revenue grant, meaning that you must match them with the related expenses. So revenue, match it with the expenses. Okay, so let's say the government is offering grant for businesses that hire unemployed graduates. So let's say the cost of hiring the unemployed graduates will obtain financial assistance by the government through the receipt of revenue grant. So this grant revenue that we receive from the government will have to be matched with the appropriate expenses. We will look into that later on. We have one example for that. So what you have to understand is the government that the grant that we receive must be matched with the related costs. Okay, so that is revenue grant. What about capital grant? So as I have explained just now, capital grant relates to the grant given for the purchase of non-current assets. So when we talk about capital grant, they can be presented in two ways. There are two methods to account for capital grant: by using the deferred income method, or by using the by deducting the grant amount from the asset carrying value. Alright, so meaning that for capital grant, there are two methods. The first method is by using the deferred income method. The second method is by deducting the grant amount with the carrying amount. Alright, so but in the UK, the second method here is non-allowable. So we can only use the first method, which is the deferred income approach. So later on, we will see how are we going to use this deferred income approach to recognize our capital grant. Okay, this is the example. Alright, we have this company called Torino has just purchased a fleet of energy efficient vehicle costing £300,000. The vehicle have a useful life of 5 years with no residual value. A government grant of 50,000 was received with the cost of the vehicle. So this company, they purchased this non-current asset, and the government is offering them a government grant of £50,000. So how do we record this transaction? So we will look into both methods, the deferred income method as well as the method number 2, whereby we deduct the grant amount from the carrying value of the asset. So let's look at the first method. Alright, so in method number 1, what you have to do is, first, you have to write what is the asset cost. So the asset cost is 300,000. You minus with the depreciation, and this gives the carrying value of the asset for 240,000. So this 240,000 is the amount of your asset carrying value. So this is the cost. This is the accumulated depreciation. Okay, just like normal PPE recording. So not much different. The only difference is in terms of this one, the grant. We receive grant from the government of 50,000, and this 50,000 pound need to be amortized based on the useful life of the asset. Amortized meaning that you take the whole 50,000, the amount that we receive from the government, divide by the useful life of this asset. So meaning that every year we have to recognize grant of 10,000 ringgit. Okay, so this 10,000 ringgit is the amount of grant that we have to recognize every single year. So meaning that at the end of the first year, we will have remaining grant of 40,000. And remember, this grant is part of your liability. Why? Because this is recorded as part of your deferred income. So deferred income is the same meaning like prepaid income. So prepaid income, we have to treat it as part of our liability. Just that for deferred income for grant purpose, there are two types, which is current liability and also non-current liability. So you know that out of this 40,000, 10,000 will be recognized in the next 12 months. So meaning that in the second year, you will release another 10,000 of government grant. So the difference of 30,000 will be recorded as part of your non-current liability. So the main thing that you have to understand here, if we use the first method, is first you have to record the asset at cost. Okay, record asset at cost. Okay, the cost is 300,000. minus the depreciation, then you get the carrying value. After you record the cost, then you have to recognize the amount of grant income that you should receive for that particular period. Okay, so what is the appropriate double entry for this? So maybe by explaining the double entry, it helps you to understand better. Alright, so meaning that in the initial recognition, when we buy the asset, so you have to debit the asset by 300,000, credit bank 300,000, assuming that we buy this asset by using our bank account. Okay, so this is the first transaction. You have to recognize the purchase of the asset. Secondly is, yes, you receive grant from the government. So remember, this is your deferred income. So you have to debit bank because you receive money from the government, debit your bank and credit your deferred income. And this one is your liability. Okay, why liability? It's the same concept like prepaid revenue or prepaid income. Okay, remember prepaid revenue or prepaid income is our liability. It's like we are owing someone. Okay, at the end of the first year, you have to record the depreciation. This one is normal. So 300,000 divided by the useful life. So depreciation is 60,000. And also you have to recognize the 10,000 pound as part of the grant income. So you debit the deferred income and credit the grant income. So this one is how much you recognize in your P&L. So this one is recorded, will be posted in your P&L. So this one will decrease your deferred income. So at the end, you will have a remaining balance of deferred income by 40,000, and these 40,000 have to be classified into current liability and non-current liability. So another 10,000, you will recognize this 10,000 next year in the next 12 months period. So this should be classified as part of your current liability, and another 30,000 will be recorded in your balance sheet as part of your non-current liability. So this is how we record the grant received by using the deferred income method, which is method number 1. Alright, so it is a little bit confusing when it comes to this part. You must remember that the grant that you receive need to be amortized to the useful life of the assets. Alright, so this is the first method. Okay, so if we need to use the second method, so in the second method, you simply deduct the grant amount from the asset cost. Okay, but this method is not allowable in the UK. So most likely when you are answering the exam question, maybe you are required to use method number 1 only. So to be safe, just use method number 1 only. Okay, so in this method number 2, it is more simple, whereby you just deduct the amount of grant that you receive from the asset cost. So the asset cost you for 300,000, you minus the grant of 50,000, and this gives you a depreciable amount of 250,000 divided by the depreciation. So this would be your asset carrying value at the end of the first year. Okay, so meaning that in this method number 2, you have to record the asset after deducting with the grant. Okay, so this is method number 2. Alright, so next, let us look at, okay, non-monetary grant. So as I have explained just now, so not necessarily that the government will give you in terms of money. Sometimes they can also give you in terms of like fixed asset like land or other resources. So in this case, the land or other resources can be accounted at fair value or at nominal value. Alright, so let's say government give you grant at the first place, and requires you to pay back after certain period. So if the grant become repayable, so it is treated as a change in accounting estimate. So meaning that the journal entry for repayment of grants will look like this. Okay, of course you credit bank because you need to pay. So when we pay, we will reduce our bank account, so you credit, and then you debit the deferred income. Okay, debit the deferred income by how much that you have not recognized, and also you debit the excess expenditure. Okay, so this is how you account for repayment of grant. Alright, so let's look into our last example for this government grant. Okay, we have this company called Tom has opened a new call center in an area of high unemployment and has received a government grant of 1 million in relation to the cost incurred. 800,000 pounds of the grant relates to the cost of the new call center building, which costs 4 million in total and has a useful life of 20 years, and the remaining 200,000 is receivable on the basis of Tom Limited creating 200 new jobs. As at the reporting date, Tom has created 50 new jobs. So if you look at this example, actually it involves two types of grant. Okay, so the government is offering Tom 1 million government grant. Okay, so it is this 1 million is divided into two different things. So 800,000 is related to building. Okay, building cost, the new call center building. So this is for the building related to the cost of developing that area. And another 200,000 is actually relate to job creation. Okay, so this one, the building here, this one is the capital grant because it relates to non-current asset. But for the job creation one, okay, to help reduce unemployment, so this is one example of revenue grant. Okay, so any cost that relates to the hiring the unemployed people will be matched to this revenue grant. So how do we account for these two types of grants? So let's look at into the solution. Alright, so first let us recognize the capital grant of 800,000. So again, the asset cost is 4 million. So if you see from this question, here, it say that the cost of the building is 4 million. So this is the cost of the asset. The cost is for 4 million. And then the depreciation is 200,000. Why? Because you have to divide with the useful life of 20 years. So the asset carrying value for the first year would be 3.8 million. Alright. So the grant that the government offered to Tom Limited is 800,000, and this 800,000 need to be amortized based on the useful life of the asset. So 800,000 divided by 20 years. So every year, this company can recognize government grant of 40,000. Okay, so every year this is the grant income that they can recognize. So at the end of the first year, so the remaining grant that this company still have, so this will be part of the company's deferred income. Okay, so this deferred income, there are two classifications. 40,000 will be recognized under current liability and 720,000 will be recognized under non-current liability. So to look into the journal entry, of course, First, you have to debit the asset, cost and credit bank, assuming that we use the money at the bank to develop the building. And then we receive money from the government. So debit bank 800,000 and credit our deferred income. So now this is our liability. So at the end of the year, you have to calculate the depreciation cost, as well as you have to recognize what is the amount of grant that we can recognize to our P&L. So this credit grant income here, this one will be included in your P&L, and this one will reduce your deferred income that you write in your balance sheet. So at the end of the year, you will have remaining balance of 760,000, and this 760,000 need to be classified into current liability and non-current liability. So this is how we account for the capital grant by using the first method, the deferred income method. Alright, so what about the revenue grant? Okay, revenue grant of 200,000 ringgit. Okay, so mentioned in the question, the remaining 200,000 grant receivable is on the basis of Tom creating 200 new jobs. So this indicate a revenue grant. So a grant that is receivable as a compensation for a cost that is already incurred should be recognized as an income in the period in which it is receivable. So meaning that you can recognize part of this 200,000 as part of your income. Alright, so in this case, 200,000 pound is given to create 200 new jobs. But as of now, Tom has only managed to create 50 new jobs. So you have to match this 200,000 pound with the 50 new job created. So meaning that you can only recognize 50,000 pound. Instead of recognizing all 200,000 pound, you can only recognize 50,000 pound only. Why? Because you have only created 50 new jobs. So it's like this, the equation like this. So government give you 200,000 pound for you to create 200 jobs, 200 new jobs. But as of now, you only managed to create 50 new jobs. Okay, so how much that you should recognize? You should recognize only 50,000 as part of your grant income. So how do we record this thing? Okay, so what about the other 150,000? 200,000 minus 50,000. So the remaining 150,000 will be held as your deferred income. So to record this, okay, so when we receive the government grant, we debit bank 200,000, credit the deferred income by 200,000 as well. And at the end of the year, upon the creation of 50 new jobs, we have to debit deferred income by 50,000. So please refer to the working here. Okay, 50,000. And you recognize grant income of 50,000 in your P&L. Okay, so this is how you record capital grant and revenue grant. So in the next video, we will be looking into another IAS, which is the financial instrument.